Good morning, everyone. Welcome to today's webinar on understanding corporate taxation. My name is Cliff Turner. I'm an entrepreneur ecosystem strategist with ATB, and I'm pleased to be your host today. To get things started, I'd be curious where everybody's from. I'm sitting here in the west end of Edmonton, where we just had a huge dump of snow over the past 15 minutes. So I don't know what it's going to look like when I go outside, but I'd be curious where everybody else is from. So if you could go in the chat, just put in the city, the town, the municipality, wherever you're from. If you'd like to throw your business name in there too, that would be great. And that way we'll just get a sense of where we're all at across the province. And that being said, we are all in Alberta, and that means we're all on Treaty 6, 7, or 8 territory. And we also acknowledge Treaties 4 and 10. Now, when it comes to land acknowledgements, one thought that I've always had is, we walk this path collectively towards reconciliation, and it's something that we all do together. But at the same time, we all have our personal growth and our personal responsibilities along this path. And I noticed a few months ago that I heard about these treaties all the time, whether it was webinars like this one, in-person events, hockey games, you name it. We're doing these acknowledgements. We hear about the treaties, and I realized I don't know what they are. I had no idea what was in the treaties. And so I did a little bit of research. Because I'm in Edmonton, I'm on Treaty 6 territory. So I looked at a website, treaty6.org. And if you spell out the 6, that's how you get there, treaty6.org. And I was really blown away by the information that was there and how much it helped me understand my responsibility on this path towards reconciliation. Because in that website, they had the original treaty all spelled out there in the original phrasing, the original language. And then they had kind of almost an interpretation, because these were written 150 years ago. A lot of the terms and a lot of the phrases maybe didn't really translate in today's language, but they had that translation there so we could understand what was meant by these treaties. And it also explored, because it's 150 years later, what does it mean, the spirit of these treaties and the purpose of them? How do we bring that into today's world as we walk towards reconciliation? So it was a really good education for me. It put a lot of context around things. And I'd just like to encourage you to do the same thing. Again, if you're in Treaty 6, it's treaty6.org. If you're in one of the other treaty territories, I'm sure there's a website that is very similar for you. A quick Google search should bring you there. But with that being said, I'd like to introduce the speaker and the topic that we'll have going on for you today. So today we have Vartika Satija. She's a Calgary-based independent professional accountant that provides professional services to individuals, sole proprietors, small and medium-sized businesses, and nonprofit organizations. Her passion is to partner with individuals and businesses to provide ongoing guidance tailored toward their unique financial and tax requirements, and to help them grow and achieve their goals. Her intensive experience includes personal and corporate tax compliance, tax planning, and other business advisory services. And she has experience with all sorts of industries, such as manufacturing, professional services, construction, retail, restaurants, and real estate. Today, Vartika is going to share with us some practical insights into optimizing corporate tax planning. That's a hard one to get my tongue around. Mitigating risk and ensuring proper compliance. Some of the key topics that she'll be covering include corporate tax basics, including how corporate taxes vary based on the legal structure and jurisdiction of the business, key components of corporate taxation, such as taxable income, tax rates, deductions, and credits. She'll also be looking at common tax planning strategies that corporations can use to legally minimize their tax liabilities. Government tax incentives and subsidies will also be covered, and the important distinction between tax planning and illegal tax evasion. So before we get started, just a quick note for everybody. If you have questions anytime during the webinar, feel free to pop them into the chat, and we'll try to get to as many as we can at the appropriate times during the webinar. And then after today's webinar, you'll receive a follow-up email where you'll be able to access the recording of this presentation and some other follow-up materials as well. So with that being said, Vartika, I'll turn it over to you.
Thank you so much, Cliff. Just want to make sure you guys can hear me okay, correct? Moving forward, so thank you for that introduction. As Cliff mentioned, I do work with a lot of small to medium-sized businesses here in Calgary, Alberta. And today's topic will be understanding the corporate taxation and navigating the landscape. So before we go ahead, I just want to, always bring up the disclaimer saying that any information that I'm going to present today will probably be more on informational, like take your specific situation, your business needs, make sure that you do seek for an accounting or a tax advisor out there specific to your business needs. But again, today's information is going to be on a very generic basis. Also, just knowing that in Canada, we are always so busy with the Department of Finance. There's always laws that are changing, new updates coming through. So anything that I talk about, presented in in today's circumstances. However, things can change in the upcoming months. As we know, in Canada, things on the tax level do change from month to month and year to year. So just be mindful of that. So moving on, what are some types of corporations that we have? The classification of corporations is what dictates the eligibility for specific rates and deductions in a corporation. So first, we heard this word called Canadian Controlled Private Corporation, CCPC. I will go more into the details of what that consists of, but this is one of the types of corporations, and most small businesses, private corporations, do fall under a CCPC category. Other ones are called other private corporations. We'll go more into the details of that. Then we have public corporations, and then we have corporations controlled by public corporations. It seems like my voice is a bit choppy. Can you guys hear me okay now? Am I good? Okay, I may just move on. And if there is, okay, great. So it looks like my voice is now good. Thank you very much. And now we have other corporations such as credit unions and so cooperative corporations out there. So these are most of the types of corporations in Canada. We will know what rates or deductions basically apply to them. So we will go more into detail of CCPCs, but before that, we talk about what other private corporation basically consists of. It's a resident of Canada, it's not a public corporation, and it's not controlled by one or more public corporations or controlled by one or more federal crown corporations. So basically, a non-resident can basically have other private corporation. But again, the existent of the actual corporation is in Canada. So it is a resident of Canada, can be owned by a non-resident, however, cannot be owned by a public corporation. What is a public corporation? Public corporations are corporations where the classes of shares are listed on a designated stock exchange, or their elected or minister of national has designated on a public corporation. So we know the stock exchange. Now, corporations controlled by a public corporation. So if a Canadian corporation is a subsidiary of a public corporation, it falls under this category of a corporation controlled by a public corporation. So again, a public corporation on a stock exchange, also a corporation that is a subsidiary of a public corporation falls under this category of controlled by a corporation, public corporation. Moving forward, we'll go more into the detail of Canadian controlled private corporation because I feel like majority of us, we do fall under this category. So what is a CCPC? A CCPC basically are a corporation that meets all of these criteria. A corporation that should be held privately. So the shares are actually held privately. It's not open to the public to buy shares. It has to be a resident of Canada and has to be incorporated in Canada. It has to be controlled by Canadian residents or Canadian-owned entities. So this is very important when it comes to distinguish between a CCPC versus other private corporation, because the other private corporations can be owned by non-residents, but the corporation has to be existent in Canada. The corporation must not be controlled by a Canadian resident that lists its share on a designated stock exchange outside of Canada. So this definitely will not apply to CCPC, cannot be a public corporation, and no class of its share of the capital stock is listed on the designated stock exchange. So in order for it to be classified as CCPC, it has to meet all these criterias. All right. So, what are the different kinds of income that a corporation earns? So, it all depends. The tax rate that is applied to different kinds of income depends on what is the sources of those income. So, we have heard this word called active business income. So, that is our operating income that we earn in the operation of the corporation. So, whatever active business that the organization was actually registered for. That's called the active business income. Now, we will talk more into the details of this because we are seeing these structures, income from personal services businesses. That's also one of the kinds of income that an corporation earns. Investment income. So, we have to make sure we understand that in investment income, like consider passive income, where basically, you have an asset or you've invested into an asset, and then that's just generating you passive income. So that definitely does get classified separately as a separate source of income in a corporation, and it's taxed differently as well. Capital gains income. So, if you had capital assets and you sold capital assets, the capital gains basically is taxable 50% as of today in Canada. And that's a separate category of income that the corporation has received, and is taxed differently from a corporate level as well. And other types of income, if there's dividend income, interest income, royalties income, all those rental income. So all those incomes are again taxed very differently in a corporation, not taxed at the same level as an active business as well. So this is very important to understand the classification of what kind and sources of income we have, because that's what determines how you're going to be taxed within the corporation. So so let's say you're a corporate, you're a Canadian entity. Again, it can be any entity, basically. And the first tax rate that you get taxed is a general tax rate of 38%. So that applies to all Canadian resident corporation or on the taxable income earned in Canada, even if it's by a non-resident corporation. So that's your general tax rate. Now, the second level, you get a federal tax abatement, which is 10%. So that's actually deduction equal to 10% of the taxable income that's earned in your corporation. And that's basically to help the corporation to make some room for provincial taxes, which we will get more into the details later as well. And then you get another general tax reduction of 13%, which again equals to 13% on qualifying income. So you have to have qualifying income to get an additional 13%. So overall, every Canadian corporation basically is being taxed at a rate of 15% after applying the tax abatement and the general tax reduction. So that's the tax rate that a corporation will have to pay, if for all the Canadian corporations that are out there. Now, again, this does not apply to the public corporation. This is just a Canadian corporation. Let's go into a detail. Let's just go a level down and actually look at a tax rate that gets applied to a small business. So, what is a small business basically categorized in Canada? So, first category for a small business will be is to be classified under CCPC. So, you have to meet all those conditions to be considered a small business under CCPC. And if you are, you probably can qualify for something called a small business deduction, which is again only applicable to CCPCs. What are some criterias? Now, the small business deduction is only applicable on active business income from partnership, active business income from provision of services to a private corporation. So again, the small business deduction rate is only applicable to active business income and no other income. So if you are a small business and you are a CCPC, but you make only passive income, the small business deduction rates don't apply. The other condition is it only applies up to a maximum net income of 500,000 for associated group. We will go a little bit more detail into what associated groups mean, but your income, your net income in the corporation is below 500,000, and that's where you get the small business deduction rate on the active business, or your aggregated taxable capital employed is less than $10 million for associated groups. Okay, so going further, that is only applicable to small businesses making under 500,000. What tax rate are you actually paying? So again, you start off with your 38%, which applies again to any Canadian resident. Then you get your federal tax abatement. Again, that applies to all Canadian resident corporation. You get that 10% deduction that again allows for the room for the provincial taxes, but then you get an additional reduction of 19% because you're classified as a small business making under 500,000. So as you know, the end result, the net federal tax business tax rate for CCPCs on the active business income turns out to be 9%. So you can see, being a small business making 500,000, you get the small business deduction, again, only for CCPCs, and that brings your federal tax rates in the corporation to 9%, which is a pretty sweet deal for small businesses out there. So I know we talked about associated corporations. So what is association rules out there? Again, this is basically defined under the Income Tax Act and very important for determining the eligibility for certain tax benefits, such as specifically the small business deduction. So when two or more corporations, are controlled by one corporation, when one corporation is actually controlled by another corporation, and control here definitely refers to indirect, direct, or chain of control, or the two corporations are controlled by same people or group of persons, referred to the corporations owned by the same business owner or group of directors. So what does that mean? They want to make sure they limit the small business deduction within the associated groups that are controlled by the same individual. So it's the same business owner owning one or two or three corporations. They want to make sure that $500,000 limit is actually shared between all the corporations, just so that individuals, you do not go out and start, opening up multiple different corporations just to be able to take advantage of the small business deduction. So they want to make sure that you are sharing this deduction rules within the corporate group. And in order for you to be considered a corporate group, again, if one person owns multiple corporations, or if one corporation owns another corporation as well, will be considered under an associated corporate rules. So I'm going to have Carrie actually give you more details as a CRA guidance of whether your corporation is considered associated or is and has to share the small business deduction. Another thing also having to keep in mind is whether one corporation ends up becoming related to another corporation. So you have to also look at those rules in place. So there are situations where, they're husband and wife and they both own their own corporations. But the fact that the husband and wife are related, now those two corporations also become related to each other. So you need to keep in mind those rules when you're actually trying to share those small business deduction, limits out there as well. So moving on. So we have talked about corporate taxation for active business, but corporations that are making passive income. So passive income, basically income from interest, dividend, rents, royalties, capital gains, and of course, any other kind of other income that you're receiving. So those investment income are taxed separately in the corporation. They're taxed a little bit higher. So again, we start off with the same general rate that every Canadian corporation has to pay. Then we get that 10% abatement, again, just to make room for those provincial taxes. And then we have an additional 10.5% tax rate on those investment income. So that being said, if your corporation only makes investment income, on that investment income, you're almost paying 38.6 7% taxes. And this is basically to give to not give advantage to corporations who are making investment income with corporate money versus an individual who is actually making, they're using after tax money to make investments personally. They want to make sure it's a fair deal for individuals who are making that investment personally versus a corporation making that investment income. So if you look at the analysis, most likely, the individuals making investment income and being taxed on investment income versus individuals who have using corporations making corporate investments, and using that money for investment purposes gets taxed at the higher rate. However, if that individual shareholder withdraws the money from the corporation, then the corporation can recover 30.6%, 30.67% of tax back into the corporation. So there is a dividend refund that you can get into the corporation if that money has been flown out to the individual shareholder as a dividend. So again, as a result, you will probably not see a very big difference in the tax rate on the investment income in the corporation versus an individual who takes it out personally and invests it personally. So I think I'm going to stop here right now and Cliff, just see if there are any questions for me.
Yeah, Varika, this is great stuff. But we do have one question came in from Timothy. He was asking about the tax rate for dividends that are withdrawn from a corporation. If you could kind of give him some general idea there.
Yeah, so it all depends. When we are saying tax rate for dividends withdrawn from the corporation, so what I'm understanding is that individual shareholder getting a dividend from from the corporation personally. So that will always be taxed on the personal tax rate on the personal level. So basically, you have to go back and look at the grid line, right? Like we start at 15% when we go into 20.5%, then we go into 26%. So it depends on how much dividend the individual is getting on the personal level and what level and what other tax credits and deductions they have on the personal level to be taxed personally for that dividend that they're giving. Now, in the corporation basically does not get a tax deduction just because they're given dividends, because dividends are after tax money that are distributed to shareholders. It's salaries that give you a tax deduction in the corporation. So I hope I have answered the question there.
Yeah, we actually also had another one just come in. Samir is asking if you could talk a little bit about long-term capital gains exemptions. Maybe you're planning to cover that later on in the presentation, but if not, maybe we can.
No, I did not get into the capital gains exemption because, again, that is basically if an individual sells their shares of the corporation and then they have if they qualify under the small business qualified business corporation shares, there's a criteria to match those ones. If they do qualify and they do sell their shares in the corporation, on the personal level, they could get that exemption called the capital gains exemption on the sale of the shares to a third party. I can actually do a whole presentation on that. But no, we don't go much into the details on the sale of the shares of their corporation. And because that's, again, on the personal level that the individual gets the capital gains exemption, not the corporation.
Okay, well, in effort to keep us on track here, we'll have to move on to the next part of the presentation, but I know there's some other questions coming in. Keep firing them in and we'll get to them as best we can. Back to you.
Sounds good. Awesome. So that was a great question. So let's move on. I just wanted to quickly bring this grind to small business deduction, right? So this was, again, applicable for taxations years after 2018, where the small business deduction will be reduced for CCPCs if your aggregated investment income has, exceeded 50,000 and then it diminishes at 150,000. So if you actually have enough investment income you have enough investment in your corporation and it actually, brings you income over 50,000, but then it brings you an income up to 150,000 of investment income in the corporation, you'll start to see a grind in the small business deduction. So the grind happens at the rate of $1 for small business limit for every $10 of aggregated taxable capital. And then it would entirely grind down if your taxable capital actually exceeds 50 million. So you want to be mindful and make sure you do proper tax planning when it comes to, starting to use corporate money for investments in the corporation, and see what's actually beneficial, whether to do take the money and invest into the corporation, or take that money out personally, pay personal taxes, and then invest that personally. So there's a fine balance of making sure you're doing that that tax planning within the corporation, so you don't fall under the grind of losing the small business deduction. So personal services business, again, this is becoming more and more prevalent, and CRA is going out and, I would say, audit more of these personal services business. They're actually doing a lot of educational programs, and this is basically for individuals who are carrying on a business where the individual is performing services as an incorporated employee. So what does that mean? There are a lot of companies out there who are hiring contractors and asking them to be an incorporated business instead of putting them on a payroll, or paying them personally as a sole proprietor. They're asking them to be a corporation. However, the terms and conditions of like the way they work, they're only working for that one company out there. They're no different than an employee, because again, they have this one client they're getting paid from. It's a very, like, they invoice them on a very regular basis, and they end up just working on that one project for that one client. But it's all run through that incorporated company. Again, like, this was a very acceptable structure back in the days, but CRA is starting to get more and more. They're trying to do more and more pilot projects with, like, doing more audits on such individual businesses and individuals who are running them as an incorporated employee, because again, from their point of view, they are no different than an employee that's working for a corporation, because they're like, there's no control. Like, all the tools are being provided by that individual employee. Like, people are actually working on their server space. They're getting computers. They're getting all kinds of supplies, and they show up same as an employee. But again, they're getting paid through a corporation, and the corporation is paying small business corporate rate, again, paying less taxes, whereas the individual only pays taxes on the personal taxes when taken out from the corporation. So they don't want those companies to be existing, and they are getting out and doing a lot of pilot projects. I've asked Kerry to put a link of the recent pilot project that was done in November of 2023, where they went into the corporations to actually ask them to provide them a list of all these contractors who are working for them, and what are the arrangements with these contractors. Again, so the only exceptions they would make, so let's say you do have this one big client that you work for, but you have authority to go out and you as a corporation has the authority to go out and hire 5 full-time employees. In that situation, they may give you that exemption that, okay, you are a small business, incorporated business, and you're actually not running this as a personal service business. Or you can actually prove through other tests, like, for example, you are able to take the risk in case the project doesn't go through. So, or you're able to hire other subcontractors to work and perform services for that contractor, or you can actually prove that you have multiple sources of income. So you have income from different sources, not just that one customer. And then you can choose your own hours. Like, you don't have to actually report and go to this one office space based on somebody out there who's designing your hours to work on the project. As well as you don't have, like, somebody who's reviewing your work, right? Like you are basically running this as a sole entrepreneur, sole self-employed individual, where nobody's really overseeing your work. So if you can prove that, then maybe yes, your corporation can go ahead and file as a corporated entity. However, if you can't prove those things and you are considered a personal service business, then there are different tax rates that get applied. So what are the tax rate that applies to a personal service business? Again, we start off with the same general tax rate. We get the federal tax abatement, but then we get an additional 5% called PSB tax rate on that, for the incorporated company. In that situation, you will see your net federal PSB tax rate actually becomes 33% just on the federal level. We still have to add on the provincial tax rates as well. So you can see the difference between 9% of tax rate in the corporation when you're just a corporated employee, like an incorporated CCPC, versus if you are considered a personal services business. And the reason I'm bringing this up, because again, CRA is getting out and auditing this more in the last year. They have started their pilot projects, as well as they are right now doing an educational workshops. However, eventually they're going to start doing the audits on individuals who actually have these incorporated companies, because they're losing a lot of taxes when it comes to personal taxes for PSB versus a corporate. Now, another thing you want to be mindful, if you are a personal service business, the only deduction the corporation can take is the salary. So what they want is that the corporation brings in all the revenues from the customer, and that the revenues gets flown through to the individual shareholder as a salary. So then, of course, when you're getting it, when you're actually, flowing it through as a salary to the individual shareholder just pays the personal tax rates on that salaried income, just like, being on a payroll for that corporation. Okay, moving on. Let's talk about provincial taxes. We all, of course, pay the federal part. So all the tax rates that I just discussed were all on the federal part. Now, provincial taxes will depend on the permanent establishment of the corporation in the province. And how do we determine that? So, of course, that will be determined from where is the fixed place of business and where's the principal place of business. Where are the location of employees and agents with general authority to contract for the employer, right? So where are the employees actually established, and where are they actually performing the services from? If you have land, if there is an ownership of land, location of where the substantial machinery or equipment is actually utilized. So if you are a manufacturing entity, where are the locations of the substantial machinery and equipment that is actually happening, and which location is actually going through. So, and now in situations where there's no permanent establishment, then the way the government actually deems the permanent establishment is where the head office or the registered office is specified within the incorporated documents or the bylaws. So when you went to incorporate the corporation, which province you actually incorporated that, the corporation, which incorporation, what are the permanent establishment established on the incorporated documents or the bylaws of that corporation. So that's basically how you can determine if you have a permanent establishment in that one particular province. Another thing you want to also understand is, like, nowadays you do have individuals who are establishing in or providing services in multiple provinces. In that situation, you will have something called as extra provincial incorporation. Basically, you have a permanent establishment not just in one province, but in multiple provinces. And if that's the situation, then multiple provinces tax rates will apply for your corporation. And how the tax rates are applied is based on the proration of the revenue and proration of the salary and wages paid in those individual provinces. So if you have a permanent establishment in Alberta and in BC, so depending on revenues that are generated in BC versus generated in Alberta, they will be taxed separately for those provinces. The tax rates will apply for those provinces on the proration of revenues earned in those individual provinces. So that's how you will have to understand provincial rates will apply based on the permanent establishment in those provinces and the revenues earned in those provinces as well. Okay, so just to summarize, the corporate and corporate tax rates for federal and provincial. So this is just a summary. As I mentioned, if you are an active business income, where your income is up to 500,000, based on all the abatements and reductions you get, you are paying federally 9%. And if you are a province in Alberta, like we have a permanent establishment in Alberta, you're paying that additional 2%. So a small business making up to 500,000 is paying 11% in Alberta. However, if you're an active business income where your income is over 500,000, your general, corporate rate is about 15%. Alberta is 10%. So you can see it's 25% is what a general corporation in Alberta is paying. If you're an individual, if your corporation is making investment income, you can see it's up to 39% in the corporation and Alberta 10%, almost 49%, pretty high. And if you're a personal services business, you're an incorporated employee of your own business, it's 33% in the corporation federally and then Alberta 10%. So you need to add the provincial tax rates as well, to the federal tax rates as well, depending on the types of income that the corporation is making. Okay, so that's a great summary. Moving on. Well, let's move on to some federal tax credits and incentives. So the first one I would like to talk about is scientific research and experimental development credits. So this is an incentive that is given to corporations that carry on research and development activities. And you can qualify up to 35% of refundable tax credit annually for the first 3 million in expenditures. So I will ask Carrie to put a link for if you guys are in that development stage. So if you are a tech company doing some kind of a protocol, like coming up with a new project or a new, you're doing some research for a new, let's say a prototype of a product, you definitely can qualify for this expenditure. There is a big criteria. There's also a tool on that link that is going to be shared with you, where the link will show whether you can actually, look at that tool to see whether your corporation's expenditures do qualify for this SHRED claims before you do apply for it as well. So go through it. Another one is foreign tax credits. If you do have, I didn't go much into detail, but if you do have foreign source income, so if your corporation is making money from outside of Canada and has paid taxes in other countries for the money that was made in other countries, you do have something called as foreign tax credit relief. So make sure, like if you are paying taxes in another country, and you can take that relief on your Canadian corporate taxes as well. This was a new credit that was applied. It's called the Air Quality Improvement Tax Credit, which is up to 25% of eligible related, expenditures on purchasing or upgrading your mechanical heating or ventilating and HVAC systems. If that was happening in the last year or this year, you have up to 25% of credit that you can apply. Another one is investment tax credit. This was proposed in the budget, where 30% refundable investment tax credits for investments in eligible properties associated with eligible activities for clean technology, manufacturing, and processing. So this is all incentives for, climate, for the climate action or getting clean technology, making sure that we are, preserving our climate here, I believe. Another one is manufacturing and processing profits. Again, if you're a manufacturing unit in Canada, you do get this credit on the qualifying profits as well. If you bought zero emission technology, if you bought those zero emission technology, so any kind of a technology you are implementing in your, businesses where you're um, you're giving some kind of you're actually helping the environment, you do have this credit as well for the technology as well. And then you have the other new credit that came out. It's for the zero emission vehicle. So basically, if you did purchase vehicles that are hybrid or that are electric ones that are, less harmful to our environment, then you do also have some more tax advantage or tax incentives that you can get from the government. And this is all just to adopt for the green environment and making sure that we are living in a more safer environment. So tax evasion versus tax avoidance, what does that mean? So CRA is actively pursuing businesses that engage in non-tax compliance or tax fraud in Canada, and this is becoming more and more prevalent. Just, I would say, more after COVID, where they're going after people to understand, whether people are doing tax evasions or are they actually structuring their affairs in such a way that they avoid to pay taxes. So they have classified tax evasion, which is of course illegal, where if you're not reporting income or you're not showing as much income that the corporation made, or you're overstating business related expenses, you're falsifying statements on the tax return, so you're not representing statements that are reasonable for tax purposes, or you're refusing to comply with reporting requirements. And more people are starting to get those notices from CRA where they're trying to send you notices to comply with reporting to the government. So if you're refusing to comply with those requirements, then they consider that to be a tax evasion. Tax avoidance is basically if you are, uh, you know, trying to structure your financial affairs in such a way to minimize your tax liabilities while still being compliant with the tax laws. So that's probably called tax avoidance, which most of us we do. That's why you come to, individual tax practitioners who do tax planning in such a way, in a legitimate way, to make sure the financial affairs are structured in such a way that we can help you defer taxes or minimize the liability within the laws. And that's what we classify as tax avoidance versus tax evasion. So I just wanted to bring this slide up to let you know what CR is doing on their side. They're basically using tools such as enhanced business intelligence and advanced data analysis to do the risk assessments of businesses. So it's not just like an individual trying to sit down and look at the data. It's more they're using the AI programs to figure out if individuals are reporting income or they're not reporting enough income or they're overstating their expenses. They can also take, if they are understanding that these individuals or corporations are doing tax evasions, they do have authorities to take them to tax courts or Supreme Court to make those decisions to understand whether the individual corporations are actually going against the tax assessment systems. Then they can actually do put you into a system called GAR, which is a tool that is used by CRA in case somebody did an aggressive tax planning. And if it does go under GAR, then you may be denied for any other tax benefits that are out there for ongoing, even if it is part of the legislation. So you don't want to be under GAR, like you don't want CRA to take you under GAR if you're doing some kind of an aggressive tax planning. And then I've also heard that they can seek compliance orders from the federal government to basically seize your bank accounts or go and get more information. Like you'll get more information from your personal bank accounts, business bank accounts, or people who are associated to those bank accounts. So, what are some compliance requirements? Again, I'm going to ask Harry to put those links also from CRA, like the CRA's guidance on the compliance requirements, as a corporation, you're required to file, your tax returns within the 6 months after the year-end date. So, everybody should probably know what their year-end dates are, and you can pick what year-end dates you want for the year, in the year, and you have up to 6 months to file those tax returns, and you have to attach financial statements and all the necessary schedules. However, if you are in an owing position, so if you are owing to the government, they want to make sure you've paid a balance to the government within the 3 months of your tax year end. So again, for a lot of small businesses, in order for you to meet that deadline, most people are done their bookkeeping, so you're ready to file it as well at that time. But if you are not ready, just make an estimated tax payment to the government within the 3 months of your corporate tax year end date. You're supposed to maintain records and documentations to support your tax filings. So CRA may audit or review your corporate tax returns. Now, again, be mindful that just having a bank statement or a credit card statement is not sufficient, like backup documentation. You have to have basically the proper receipts or invoices or lease agreements to support those, claims on your corporate taxes. If you are a corporation that owed over $3,000 in the year before, you're required to make quarterly installments as well for the next year end. That's a very important requirement. And because the prescribed interest rates are really going up high, they're almost 6, 7 to 9% in the next quarter. So if you are late on those quarterly installment payments, there are those interest and penalties that can apply. And that concludes my presentation. So let's stop here and take some questions.
Thank you so much for that, Vertica. We
Thank
do have
you.
quite a few questions coming in here, so I'll try to pick out a few and we'll dig
Sure.
into it. But, Jackie actually proposed a bit of a scenario back when you were talking about the PSBs. And so I thought maybe we could explore that a little bit. She's asking, if my sole proprietorship provides business-to-business services to a corporation who then subcontracts her out to their client, she feels like maybe they're getting double taxed on that income. Would you be able to speak to that kind of a situation?
Okay, so let's break down that question. So my sole proprietor, can I have that question pop up so I can look at that?
Should be on your screen there now.
Okay. Okay, so can you repeat the question maybe again?
Sure. The way I was reading it is she has a sole proprietorship and she
Yeah.
provides services to a business-to-business organization, but they're a corporation, but they subcontract her out to the clients. So she's wondering, are they being kind of double taxed on the income that's being generated from those clients? And what way could she set that up?
Right. So I think from her point of view, she should just be, so depending on where she's getting her money from, right? So she's a sole proprietor. So her corporation is a sole proprietor. She's not incorporated and she's providing services to certain clients. So she's getting her income from those clients. So her sole proprietorship should only show income from that particular those particular clients that she's receiving. Now, if she goes to other businesses on behalf of these businesses, now it all depends who's receiving money on behalf of this business. Is she also receiving money on behalf of this business, or those corporations are receiving the money and she just gets paid out from the corporations? At the end of the day, if she's providing services and she's providing services to these other corporations and those other corporations are paying her client, then that her client has to report all that income and pay taxes. She gets to pay taxes on the money she receives from her client. I hope I'm clarifying that, but we can definitely take this offline to clarify the business structure that's out there.
Definitely. No, that's an interesting scenario, Jackie. I'm sure Bartica would be fine if you looked her up and
Totally.
emailed her a question as well. So just to clarify a bit of the details there. So we had another one from Steve. He's asking, at what level do interest receipts become ineligible for the small business deduction? Is it the same as everything else at that 500,000?
So, interest receipts.
Yeah.
So when we talk about interest receipts, are we talking about interest receipts that you're receiving from investments that you have made into the corporation? So you've taken your corporate money, you've put it into, let's say, a mutual fund, and it's owned by the corporation. Now the corporation is making interest income. Again, if that is the case and they're making interest income in the corporation from that invested money, then the corporation will stop, like, the grind of the small business will start to happen at the $50,000 of interest income up to 150,000. When it reaches the 150,000, it's going to, like, pretty much have no small business deduction available to them.
All right. That's great.
Yeah.
Yeah, I think we've got time to get through a couple more questions
Sure.
here. Let's see. Sandy had an interesting question too. She asked if the business owner has another full-time job at another company, but they still own a small business as well as having that full-time job. Is there any impacts on taxation there, and what advice would you give?
Yeah. So you need to do some tax planning around there. So you're not showing up all that income personally in that 1 year, right? So that's a situation for a lot of people when they're starting these side hustles. They go incorporate a company while they're still working full time. And what I ask people to do is, again, we should be doing a full holistic tax planning there. But the money that comes into the corporation, leave it in the corporation unless you really need to use it for personal reasons. If you're bringing that money in the corporation pays a small, 11% taxes if it's an Alberta based corporation. And you just leave the money in the corporation. That's where it pays taxes. And you do have a T4 for the full-time income. So that you have no choice, but you will be taxed personally. However, if you take that money out from your corporation, then you will be taxed on that money personally as well. So then you go on to the high tax bracket. So we should be doing some tax planning to make sure you are able to minimize some tax liability if you have that corporation and defer taxes for the future.
That's sound advice there. One last question. It's similar in nature to that one, I think, but Timothy was asking if you could compare tax paid strictly as a sole proprietor versus
Yeah.
having a CCPC and then taking out dividends, and how would you think that situation?
Yeah. Again, I think that's a tax planning to be done. I did not give that link, but I do have a blog on my website called, Understanding if Incorporation is Right for You. But holistically, again, I can only talk from tax point of view and not from legal point of view. What I advise clients is if you have a sole proprietorship and you're taking out all that money personally, so let's say you're making 200,000 in the sole proprietorship, but you have personal needs that you need to take out $200,000, like you need all that money personally, then there's not much of an advantage to have a corporation. But if you can leave, let's say 100,000 into the corporation and only take out 100,000 personally, then we can do some tax planning with dividends versus salaries and try to help you defer that taxes, right? Because again, you only get taxed personally. Personally, we pay pretty high tax rates, and we want to defer that if you have that corporation set up and you don't need all that money out personally. So that's kind of how I advise clients on that.
Right on. Yeah, the sense I'm getting from all of this is, of course, there's the laws, there's the regulations, there's systems for
Yeah,
doing these things, but with everybody in such unique situations,
you have to.
it's
Yeah.
really good to get that professional guidance, which of course you're an expert
Yeah.
at. So, yeah, I'd encourage everybody on the call, reach out to Vartika and let her look at your situation specifically, and it'll be very valuable to you in the future. So thank you,
Great.
Vartika, for being with us and sharing all this information. That was amazing. And
Great. Thank you.
yeah, we'll definitely be talking to you again in the future. And one thing, just for everybody on the call, we're going to pop a link into the chat there. It's just going to be a feedback link. We'd really like to know what you think about this webinar, what you'd like to see in future webinars. So please just take a couple minutes to send us that feedback. Really appreciate that. And as I mentioned before this all started up, you're going to get an email in the next couple of days with a link to the recording of this webinar, as well as some other follow-up material. And it'll also have registration links for future webinars, and some of our in-person events will be listed there too. And just as a little teaser of what's coming up, on February 13th, we've got a workshop session focused on time mastery for success at the ATB Entrepreneur Center in Calgary. That's an in-person event. And then on February 15th, we have an evening gallery opening celebrating emerging Black artists at our branch for arts and culture in Calgary. February 21st, we have a workshop session focused on navigating HR fundamentals, and that'll be at our ATB Entrepreneur Center in Edmonton. And then on February 21st as well, we have an evening business mixer hosted by our Black Team member network at our ATB Entrepreneur Center in Calgary. I would encourage you to visit atbentrepreneur.com. There you'll find all kinds of resources, templates, guides, videos, all sorts of good stuff. But you can also subscribe to our newsletter, which will keep you updated on all of these events and resources that are out there for you. So with that being said, thank you again, Vartika. And thank you all for being on the call. Yeah, we'll see you all again soon.
Great.